All right, guys, very popular topic, ETFs, exchange traded funds. They were created to basically act as a stock, but that's a mutual fund. So in a typical mutual fund, you buy the mutual fund, you buy it based on the value at the end of the day because they don't trade like a regular stock. For an ETF, it does trade like a stock. One of the most popular ones is SPY. SPY is the ETF for the S&P 500. And as you can see here, this is going to change as time goes on in our live, our real-time feed. And so you sit here and go, okay, this is basically a stock. Now, what does this do? Very low cost. I think this one's 0.09 in percent fees per year. And it follows the S&P directly. It literally buys what the S&P has in the same breakdown as the S&P. There's other ones like QQQ does the NASDAQ 100. You can find an ETF for pretty much anything you want. Certain sectors like jets is the airline and transportation one. You can look for an emerging markets one. You can look for one that's based in a different country. You can look for them that have, there was David Portnoy from Barstool Sports had an ETF that he had based on his trading, or I don't know what it was, but the bottom line is an ETF is a way to get a low cost investment into a certain sector, industry, index, etc. And they trade like a stock. So they're constantly being traded and they're constantly going up and down. Now, when it comes to any of our data on our site, obviously we're not going to have this data because it doesn't compile all the information from the price to sales ratio, etc. But the reason why ETFs are such a valuable resource for people, guys, you've heard this before and it's 1,000,000% true. All of these big shot MBAs who actively manage their mutual funds do not beat the market. I mean, it's something absurd like only 2 or 4% over a 10-year period will beat the market over that 10-year period. And usually the ones that beat do really, really poorly at some point in that whole process. Why? Because in order to beat the market, you have to think differently. But imagine if you work at a mutual fund and you're not doing well. What are you worried about? You're worried about your job. Because if the market goes up 15% and you're down 3% or you're only up 3 or 4%, you're going to lose assets. And when you're charging 0.75 or 1% per year or higher in order to generate fees for your company, it is going to hurt you if you aren't doing well, right? Look at ARK. ARK is that Cathie Wood ETF, which I think just absolutely sucks. But she actually charges fees like it's a mutual fund. So even though it says ETF, make sure you look at the fees involved. Because if you look at the fees, you'll see how they're really structuring themselves. A company that does SPY, they're charging very low fees, 0.09%. What does that mean? That means for every $1,000 you have invested in them, they're charging you 90 cents per year. When a company like ARK charges 0.75%. For every $1,000 invested, they charge you $7.50 per year. That's 8 times more. And you might sit there and say, well, is that really a big deal? It's a huge deal. And I'll show you in a few minutes what I mean by that. But the reason being why you should invest in an ETF is, especially a market-based one, which all the great value investors believe for the average person, is because even an actively managed mutual fund can't beat the market. If you just invest in an ETF, you're basically going to get the market return. So why even deviate from that? Now, it's a lot more fun to pick individual stocks, which I don't disagree with. But 15, 20 years ago, I was 100% ETFs. Why? I didn't know how to pick stocks. But then as I learned how to pick individual stocks, I would take my 100% of ETFs and maybe take 20% off and say, I'm going to invest in stocks. And now that I feel very comfortable investing in individual stocks, I've basically created my own ETF based on my value plays, right? Now, that's something that I want you to get to if that really matters to you. But in the meantime, wait by buying those ETFs and pick a portion of your money to invest in individual stocks. And we will help you learn how to do that through our channel. So subscribe to the channel to be able to understand that. And by the way, guys, Wednesday, May 31st, 1 p.m. Eastern time, we have a webinar on another way to make money to keep yourself busy while investing, and that's through day trading. We believe in day trading, long-term trading, and swing trading. And you might be confused. How could a value guy be that way? I don't mix the two. I have separate money for trading and I have separate money for my value investments. But this is a great opportunity to go learn that. Mo, who's on the channel, is really good at trading, swing trading, long-term trading. We have a lot of great users who've done a really good job in that regard. So sign up at the link below, May 31st, 1 p.m. Eastern time for our free webinar. Absolutely free. Sign up now. So back to ETFs. Most people, when they get in and out of investments, also get in at the wrong time and get out at the wrong time. So as an example, it's been proven time and time again that even though the market may go up 9 or 10% a year, the average person probably only makes 5 or 6% because they're getting in and out at the wrong times. So when the market goes up value-wise like this, but the price goes up like this, what tends to happen is people put more money in at these points and take money out at these points because they're afraid. It's human nature. I've done it before in the past. Trust me, I've been there. I've been exactly in those shoes where I'm like, nothing's going to go wrong. Nothing can ever go right. Now, obviously, after a little bit of training of myself, I've realized that's not the case. So don't fall for that trap. What's more important to you? Is it more important for you to do well financially or feel like you're the big shot picking the right stocks? And I'm not telling you not to pick individual stocks. I'm just telling you, dip your toe in. But focus on ETFs. Make plays on sectors for ETFs. For example, if all of a sudden the airline industry was hit with something that caused all airline stocks to go down 90%, I would say to you, instead of wasting your time picking individual airlines, go pick the Jets ETF. Go buy that ETF and bet on it. If you want to make a bet on a certain country, go find an ETF that follows that country. If you want to make any sort of investment based on a certain sector, and instead of spending all your time knowing the nitty-gritty of every company, buy the whole sector by picking an ETF that matches that. And that's how you can make money with being actively involved in picking your investments. But I still think the majority of your money should go into low-cost ETFs. But let me show you how important it is to actually get to do an ETF and not think about it. This is our retirement calculator. This comes for everybody who's involved in our software. The reason I created this was every other retirement calculator I knew stopped at retirement. This one goes to the end of your life because a financial advisor will tell you, hey, you got $3 million in the bank, you're good. Well, what if you spend a ton of money? If you spend a ton of money, $3 million, let's say you spend $300,000 a year, $3 million isn't going to last you to retirement. It sounds like a big number, but it's not going to last, especially nowadays when people are living longer and longer lives. Obviously, the last couple of years, the average life expectancy has dropped, but I expect that to continue to rise over long periods of time. So if you're going to live to 90 or 100, you need to make sure you have the money to live that long. And that's why our retirement calculator that comes with our software subscription is great for this. So let's do some examples. And I know you could be age 20. People watching our videos, we have 14-year-olds who watch our videos, and we have 70-year-olds who watch our videos. I'm going to pick 35 years old just to be right there somewhere in the middle. Let's say you're going to retire at 65, and you're 35 and currently saved $250,000. And if you haven't done that, that's not a criticism. There's no better time than now to start. And let's say you're saving $15,000 a year in a tax-deferred account. And let's say every year, you're going to increase your savings by a certain percentage. Let's say 4%, because your income's probably going to go up higher than inflation. And let's say you get annualized returns in a long-term ETF of 10%. The average for the S&P is like 9.9% over the last 100 and some years. Let's assume 10% just to make it easy. And let's say during retirement, you go a little more conservative and you get 6%. And let's say you're expected to live to 95. So guys, your retirement age is 65. You're going to live to 95. That's 30 years of retirement that you need to account for. If you're 35 today and you're retiring at 65, you're going to have the same amount of time in retirement as you have remaining in your working life. That's why it's really important to focus on these numbers. Let's say inflation is 3.5% and you currently make $100,000 a year. And what percent of your income, this is the important part in this question, what percent of your income do you want to have in retirement? I always tell people, put 100%. You don't want to take away from your lifestyle. Put 100% in there. You hit generate. Do you have enough for retirement? Answer is yes. 10% a year saving at retirement. You scroll down here, you have $8.75 million in retirement. And when you pass away at the age of 95, you have $16 million. So your expenses are going to increase with inflation and your money's going to go up by 6% and you're going to kill it. Now, let's say you just put this money in a in an actively managed mutual fund, they're going to charge you 1% per year. So you're already taking your 10% down to 9, but they don't beat the market either. So let's say they trail the market by 1% a year. Your 9 goes to 8. Look how different it becomes. You actually don't even have enough for retirement anymore. You need to save around $2,200 more per year. And look, at retirement, you have 5.5 million versus 8.5, and you run out of money at the age of 92. That's why it's so important to invest in a long-term ETF and maximize those gains. Now, even scarier, let's say you get in and out of investments because things get worrisome and you go to the 5 or 6% level, and in retirement, you only get 4%. It gets even worse. You need to save $31,000 more per year. At $15,000, getting 10%, you had plenty, and you died with $16 million. At 8%, you had $5.5 million at retirement, which sounds like an awesome number. And any financial planner would be like, see, I did a great job for you, but they didn't do the full work. But you'd still have to save $2,200 more per year. Now you have to save $31,000 more per year. And look, age 65, $3.5 million. Oh my God, this is incredible. Yeah, but you're also spending $290 because of your inflation-adjusted income of $100,000 a year you want to replace. And then when do you go broke? Instead of 92 before, you now go broke at 79. This is why it's so important to invest in long-term ETFs. Don't get killed by fees. You don't need somebody to hold. This channel is how we're going to hold hands. This community for $1 a day is how you get somebody to hold your hand. There's no reason that when you have $1 million portfolio, you should be paying somebody to underperform. You're getting hit twice. I'm absolutely in favor of calling this out. And I have friends who are financial planners, and I just call it out saying you don't need a financial planner. And some people say, well, sometimes you need a financial planner to do budgeting. No, you don't. You can have it in the software here. That's the point. But you saw how much it changes things. So my question is, would you rather have an ETF generating your 9.9 or 10% returns, or would you rather save $31,000 per year more today? Instead of $15,000, you got to save $46,400 of your pre-tax $100,000 income. It's not possible, guys. It's going to be impossible. So with that said, guys, ETFs, exchange-traded funds, low costs. Make sure you look at the costs of the fees on that ETF, because some people, like Kathy Wood, masks her investments as an ETF, but charge big fees of 0.75% a year. And she sucks at investing. You're going to lose a lot of money. And that's what happens there. Now, a big question is, what are the risks of ETFs? Well, I believe that the ETFs are the reason why stocks go up really high and why stocks will fall even lower. But the reason being is when an ETF gets money in their coffers, they have to go buy stock. And when people are withdrawing money, they have to sell stock. And ETFs become very, very, very popular to the point where they are probably going to move markets to big swings on the left and right. So be ready for volatility. But remember, this plan is for those who can dollar cost average. By that, I mean, put the same amount of money in every single day, week, month, whatever you choose, year, just put it in like clockwork. And over time, you see the money grow tremendously. Look at this. Watch this in our original estimation here. If we go back to our original estimation, you start at 250. And look at these numbers. The end of the year, 290, 335, 384, 439, 500. Not big growth. It takes you to the age of 45, 10 years to hit $1 million. Let's go 10 years later. 55. You're at 3.1 million. Boom, just like that. Where am I? Right here, $3.1 million. So the first 10 years, it takes to get to the first million, but it goes up 4 times. Then the next 10 years, you're at 3.1. And 10 years later, you're at 8.75. So the risks involved with an ETF is, I don't think there are questions about if there's going to be issues in terms of liquidating, et cetera. I don't understand those exactly, and I would go research that if I were you. But even then, I think those are temporary issues and not long-term issues. Kind of like I have 90-day treasuries with the US government. If there was a default, I'm not losing my money. There'd probably be just a delay in how long it takes me to get my money at worst. So those are the things to consider. But at the end of the day, what matters to you is putting your money into a low-cost investment that follows the market. Because then you don't have to sit there and guess every year, did I beat the market or not? You basically match the market. So why get involved anymore? Guys, webinar, Wednesday, May 31st, 1 p.m., free webinar, link below on trading. That way, for those of you who do your ETFs, get a fix by learning how to trade, day trade, long-term trade, and swing trade. It's a lot of fun, and it keeps you active and busy. Thank you very much for your time.